Hi, and thank you for joining us for the second quarter market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strege. The U.S. stock market rally continued after temporarily stumbling in April due to rising tensions in the Middle East and persistent inflation. However, those fears were eased in May and June as inflation numbers dropped and company earnings remained strong. The U.S. stock market is up close to 14% for the year to date. The U.S. bond market bounced back a little in the second quarter, but remains in negative territory for the year, as anticipated interest rate cuts continue to be delayed. The U.S. stock market is off to the fourth best start ever during a presidential election year, while the U.S. bond market has had its eighth worst start ever during a presidential election year. We are recording this about a week before the end of the quarter, so these numbers could change a bit. After large growth stocks led the market rally in 2023 by a wide margin, the performance of value and growth stocks this year is much more balanced. As we have mentioned in previous market updates, the U.S. stock market is heavily concentrated in tech stocks, including what is known now as the Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. These seven companies currently make up close to 30% of the S&P 500 index, and they were responsible for about 70% of the market's return last year. While these are good companies, they're starting to look expensive relative to their earnings and assets. For example, their average price-to-book ratio, which is a common measure of relative value, is about 13 compared to the long-term stock market average of about 3. While we don't believe that these stocks are in a bubble, like that of the technology and dot-com companies in the late 90s, we believe it will be difficult for them to repeat their past success. History has shown that companies have much better performance in the 10 years leading up to becoming one of the top 10 largest in the market compared to the 10 years following. Some of these companies are still worth owning, but we believe in broader diversification in a portfolio compared to the heavy concentration of these stocks in standard stock market indexes. Looking at the stock market overall, companies continue to meet or exceed earnings expectations. In fact, 78% of companies have beaten their earnings expectations so far this year, and we are on track for the 10% earnings increase over last year that was expected. Next year, earnings are again expected to be even higher by about 15%. If this earnings trend continues, we believe that stock prices are likely to rise as well. Inflation and interest rates continue to dominate the headlines and remain the focus of many investors. After inflation moderated from its highs following the pandemic, it has persisted above 3% over the last year, which is above the Fed's target. However, during the second quarter, inflation dropped and created optimism that the Fed could be close to cutting interest rates. The members of the Federal Open Market Committee that determine the Fed funds rate still believe that rates will drop significantly over the next couple of years. While we may only get one interest rate cut before the end of this year, the expectation is that interest rates drop by around 1% next year. This could provide a boost to both the economy and the financial markets. The yield curve is very flat, which means you can purchase a short-term bond with a very similar yield as a longer-term bond. Some of those yields appear very attractive, such as high-quality corporate bonds offering yields close to 5.5%. Investors can now decide how long they want to lock in those relatively high interest rates. With interest rates expected to drop over the next year or so, we think it could be wise to extend the duration of bond portfolios and lock in those rates for a longer period of time. While market volatility will likely pick up in the third quarter as the election nears, we remain optimistic that the market can continue to do well for the remainder of the year if company earnings remain strong and inflation numbers continue to get close to the Fed's target. As always, we will continue to monitor the markets and keep you updated as conditions change. Thank you for your continued trust in us, and we look forward to seeing you soon.